Hello and welcome to Fidelity Connects. I'm Alex Gabrini, Vice President of Regional Sales. North American equity markets are off to a strong start this week as Congress begins steps to end a government shutdown. Investors are also encouraged by a surprisingly strong earnings season. And the momentum looks good overseas too, with non-U.S. markets showing accelerating earnings estimates and strong performance. But the big question now is whether markets have overestimated AI's ability to drive long-term growth and help the U.S. manage its rising debt. So what does this mean for investors and how might it shape the path ahead? Joining me now to unpack the latest macro movers impacting the markets is Fidelity Director of Global Macro, Jurrien Timmer. Good morning, Jurrien.
Good morning. Welcome to the show.
Thank you. Equity markets ended the week last week down across major benchmarks. The NASDAQ posted its worst weekly drop since April. Technology AI names were key drivers of the slide, despite some strong results from companies like Palantir. Yet today we're seeing a reversal of the slide with the news that there's light at the end of the tunnel for the government shutdown. Does the drop last week in tech AI names suggest to you that there's vulnerability in the current market leadership and in the AI story?
Not really, but what we tend to see when you have a very compelling narrative that is driving investor enthusiasm, let's put it that way, and if that enthusiasm finds its way not just in the big stocks, the Mag 7, but also in what I would call the cats and dogs of the AI story, companies that may not have any earnings but make promises. When you get into that sort of exuberant mode, you will see a lot of corrections, and they could be big or they could be short-lived. I mean, it looks like this one is already being reversed today, but that's sort of par for the course. You tend to see that. We saw that in the late 90s. Like the big bellwether stocks like Dell and Cisco, they had countless corrections of 20, even 30%. And it just shows that, the stakes are high because these are crowded positions. A lot of people have them, and they won't hesitate to take profits if any of the headlines become less favorable. And so I think what we saw the last week or two is that some of these stocks were a little bit elevated. They were trading. I mean, I think the meme stock basket that Goldman Sachs has was trading at a 280 PE. I mean, these things get kind of silly, and therefore, when they start correcting, it can take on a life of its own. But when the trend is positive and the story is compelling, and we have the earnings story, we have the AI story, we have a relatively benign interest rate environment with the Fed and bond yields down, there's a lot to like about the market. But other people see that too, and so they're in it, and you get these corrections whenever something goes the other way. But the fundamentals will ultimately prevail. And I think one view of earnings season, just that's kind of wrapping up now, is that there is very powerful earnings momentum for this market.
Right, appreciate that. So par for the course with the correction like that. You argue, Jurrien, that the market sits at a critical inflection point. On one side, you have a powerful AI narrative, as you spoke about, a cooperative Fed, solid earnings in CapEx. On the other hand, you have top-heavy market leadership, you have concentration, mediocre breadth, maybe some frothy expectations for AI-driven ROI. You described sort of a narrow path between the two. Can you tell us more about what you mean in terms of these two tails?
Yeah, so if you look at market performance historically, it tends to be a bell curve distribution, right? As many things in life are. And generally you're in the middle somewhere, between those outside tails of, so many standard deviations away from the norm. And that's by definition where we spend most of the time. Otherwise it wouldn't be a bell curve distribution. There's always a left tail out there. Most of the time, investors would think about a recession as a left tail, or a geopolitical shock, or sharply rising interest rates, for instance. And then on the right tail, you have a boom like what we're seeing right now, a compelling technological innovation, or just very strong earnings and powerful momentum. And those are the two tails. And again, normally you're sort of in the middle, but this is anything but a normal cycle, especially 2025. And so I think the market is sort of lurching from one tail to the other. After the election a year ago, the markets priced in a right tail outcome. Then in March of this year, with the tariff situation, the markets priced in a left tail. And then, the tariffs sort of went on the back burner a little bit, and we got the one big beautiful bill, and the AI momentum really skyrocketed. And so now we're back on the right tail, and that right tail is further held by the fact that the Fed is cutting rates, and long yields are very well behaved. So we're kind of threading that needle, but not without sort of lurching back and forth. And so right now, the way I would describe the tails is obviously the right tail is that the promise of AI is delivered, meaning that the AI productivity that comes out of all of this capex that is being invested will yield the result that the world needs, or at least the U.S. needs, which is that the speed limit for the economy, so the rate at which the economy can grow without generating excess inflation, that speed limit goes up high enough that the debt that, of course, we all have are burdened with, including Canada, Europe, China, Japan, the UK, the US. But if the growth rate is high enough, the debt becomes sustainable, right? I mean, you think about it, if you take out a loan to start a business and the loan costs 5%, but your business is growing at 20%, that was a good use of a loan. But right now around the world, there isn't a lot of growth because, there's an immigration backlash almost everywhere in the world, including obviously the US, but even Canada, Europe. And you have slow growth in the labor force because of demographics, and you haven't seen a lot of productivity. So the right tail is that the trillions of dollars spent on AI capex yield an ROI that is so good that the economy can reach, I guess you can call it escape velocity. And then all of a sudden, the debt becomes sustainable and you can have growth without inflation. So that is I don't know if it's pie in the sky, but that's like the right tail scenario. And in that scenario, the Fed wouldn't have to raise rates because, again, that non-inflationary run rate goes up. But that kind of boom story can easily become a bubble story, the way the internet boom did back in the mid-90s became an internet bubble in the late 90s. And that's not a prediction on my side, but everybody I talk to is asking and wondering about the whether we'll have a bubble. So ironically, if you go from a boom, which is the right tail, to a bubble, then you eventually, that bubble takes you back to the left tail, because then you have the aftermath of the bubble, which is never pretty. So that's kind of one way I would describe the tails. The left tail would be, if we end up getting a bubble, but you would go to the right tail first. The other left tail, the way I see it, is now that the tariff story is a little bit reduced as a threat after the truce between the U.S. and China, but the left tail story would be that the boom does not deliver that rising speed limit, and we get into that whole debt, cliff, if you will, where bond yields start to rise, and all of a sudden you're knocking on the door of a 5% 10-year yield. Markets definitely wouldn't like that. Also, if the Fed were to lose its independence, right? If the Trump administration manages to flip the Fed, as I call it, and it drives rates below the inflation rate, then you could get inflation, again, producing a bear curve steepening. And so that would be another iteration of a left tail. So if right now, it's all pretty good, right? Earnings season is wrapping up. The numbers are good. Valuations are high. But I think as long as earnings are delivering, investors tend to overlook valuations. So that's how I see the tail. I did want to mention one more, and you mentioned this already, but concentration risk in the markets, in the U.S. market, is definitely like a real thing, right? So Mag 7 or the top 10 stocks are above 40% of the market. And while those stocks are going up, hey, it's great, right? But if that ever were to go in the other direction, and like things never go, and they never keep going indefinitely, then just those 7 stocks going down would drag the market down as well. And so that is definitely a tail risk. I don't think it's an imminent tail risk, but it is a tail risk. And then you really need to be diversified so that you avoid that concentration risk.
Perfect. And we'll get into some of the ways that you suggest obtaining that diversification. But let's dig into the data a little bit. This week, we heard fresh concerns about inflated valuations, especially with the AI semiconductor names. We had warnings of possible drawdowns, 10 to 15% from senior bank executives. Yet you point out that earnings growth was revised up again last week. So can you help us make sense of the data and maybe interpret whether or not the market is in fact over its skis at this moment?
Yeah, so let's start with slide 2, and that just highlights earnings season, which definitely has been a very, very good one, right? So we all know the story, the earnings estimates, and in this chart, I show the growth rate estimates. This is from Wall Street analysts. Generally, as you progress through the year and you approach the earnings season, the earnings quarter, if you will, the lines come down because companies tend to guide down. The estimates generally start too high, and then companies sort of under promise, if you will, guide the estimates lower. And then when you get to the earnings season, which is the vertical line, there's inevitably a bounce. Companies, they under promise and over deliver. And that's like the oldest game in the book. And there's always a question of, okay, by how much are companies beating? And the ones that are beating them by a lot get rewarded, and the ones that don't get punished. And typically, the growth rate bounces by about 300 basis points. And you can see that in the chart. You can see that little hockey stick bounce there. The last few quarters, however, have produced a much greater than average bounce. And this one certainly has been that way as well. So the growth rate started at 7%, and it really hadn't declined very much in recent months. And it is now up to 15%. So that is an 800 basis points bounce, which is generally much higher than normal. So I think, whether that's the one big beautiful bill, all the CapEx expensing that's in that one big beautiful bill, or the AI boom, it's probably a combination of both of those. But that bounce is actually lifting the calendar year number, which is on page 3. And so remember, we started the year with analysts expecting a 12.5% earnings growth. The tariff tantrum back in March and April caused analysts to mark down their estimates from 12% to 7%. And then since then, they've been marked back up, and we're now at 11.5%, which is almost where we started the year. And it's actually already ahead of where we ended last year, which was at 11.4%. So this is a very bullish story. And it's rare for the numbers to go up during the year. Generally, you have that downward drift. So clearly, there's a lot of momentum on the earnings front. And that is allowing the market to kind of like look through the valuation a bit. But if we go to slide 6, I did a little back of the envelope math exercise over the weekend to show, okay, what is actually priced in terms of earnings? Like what does the market need to see for it to not be over its skis? And so this gets into the discounted cash flow model, which is a really great tool, but it's complicated because there's way too many variables in it. But so basically, when you look at the market and you look at what the earnings growth projections are, and if you look at the estimates for the next few years, the estimates are, or the expectation is that earnings will grow 11% a year over the next 5 years, which is actually right in line with what the realized growth rate was in 24 and probably will be in 2025. So that's pretty solid. That's not crazy. But in the DCF, you solve for, okay, if the price of the index is at the correct level, and the earnings growth is X, and we know where interest rates are, then at what equity risk premium does the current value make sense? And when you solve for it that way, the equity premium right now that is implied in that 11% earnings growth is 3.7%. That may not seem that low, but if we go to slide 5, you can see that it is definitely below average, right? So if you go to the bottom panel there, you see that the gray line, so the historically realized risk premium that investors get from investing in equities over the risk-free asset is about 5%. And the average of the implied, so not the realized, but the implied risk premium is around 5%. Right now, we are well below that. So if we go back to slide 6 for a moment, the math exercise is that, okay, let's say the market is normally valued at a risk premium that is the average, around 5%. Instead of 3.7%. What would earnings growth need to be to justify the current S&P 500 level of about 6730? And the answer is 18% growth. So again, the only way the market makes sense at an 11% growth rate for earnings is if the risk premium is below average. If the risk premium was at average, you would need to see 18% growth in earnings to justify current levels. So that doesn't mean the market's going to like crash or fall 20% because it's over its skis, but it shows you that the market needs a lot of ongoing momentum from earnings to justify its current price. And maybe it will get that. Maybe this AI boom does deliver, but it shows you that the market is priced for success here.
Right, fair enough.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of Fidelity Connect's podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connect's, The Upside, and French Dialogue Fidelity podcasts, available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
The U.S. government shutdown has deprived investors of a lot of the country's most important economic data over the last month or so. We have seen some economic data come through. Consumer confidence dropped to its lowest level in years. The labor market is showing signs of stress with a rise in layoffs. So given that backdrop, how confident are you in the earnings thesis over the next 3 to 6 months? And how do you factor in labor market risk into all of this?
I think the earnings story is pretty robust, and I'm not really questioning it because of the lack of economic data. And we have our own internal, of course, earnings projections from a company by company level, and we're actually fairly enthusiastic about companies' earnings as well. We have had a dearth, of course, of data since August, I guess it was. But there are real-time indicators that we can look at. For instance, we don't have the inflation data, but there's a series called Trueflation, which is a blockchain-based algorithm that scans millions of SKUs every day. It's actually a daily indicator, and that's running at about 2.7%. So that's in line with where the government posted inflation data are. The jobs market has been soft, as we know, and we haven't gotten a payroll report in a few months. We have seen some layoffs, but I would say the jobs market is sort of in a detente where companies are not really hiring, but they're not really firing other than those layoffs. And again, there are state-by-state level indicators. We have jobless claims, which are posted every week. We have the JOLTS report. We have our own proprietary indicator because Fidelity administers so many benefits plans, so we can see a good section of the economy in terms of what we see in people in companies posting declining or rising benefits. So by no means is the economy sort of on the brink or falling off a cliff or anything. And so I think even if the numbers come in weaker on the payroll side, which they probably will. I think the market is relieved that we're at least moving back out of this the shutdown, and current indications, as you mentioned, are more constructive on that side. So I hope the shutdown ends soon, because we want our air traffic controllers to get paid, because as someone who travels frequently, it hasn't been a pleasant story the last few weeks.
And I'm sure you want access to the data that you normally utilize, although it doesn't sound like you're missing it too much with all the access to proprietary data that we have. You mentioned the concentration risk, the very real concentration risk earlier on in the show. You've emphasized the value of global diversification to help combat that concentration risk. What allocation shifts make sense today, given that environment? Maybe talk about the international markets and how we should be thinking about exposure there.
Yeah, so if we go to slide 12, so again, and most of you are familiar with my thesis that we're living in a sort of in a post 60-40 world, where the 60 obviously is the anchor for any long-term portfolio, but the U.S. side of that 60 does have concentration risk. It has valuation risk. It has that risk of a boom becoming a bubble, which is a risk that you don't really see in many other parts of the world because they don't have the same story. So the 60, I think, is still the 60, but maybe more of a global 60 than a US-based 60. And the global story is very compelling. And actually, if we go to slide 4 real quick before we go back to this one, non-US markets are now outperforming the US by 800 basis points on a year-over-year basis. That is the highest in almost 10 years. And so that's a very good story. And again, like especially non-US developed stocks are very competitive now with the cap-weighted S&P, like the growth in the payout, that share of earnings coming from dividends and are being returned to investors as dividends or buybacks is actually growing faster in the EFA index. The payout ratio is the same, 75%, yet its PE is at 15, whereas our PE in the US is 23. So very, very compelling story. If we go back to 12 for a second. So the 60 is the 60, and you can see in this chart, I'm showing the correlation of the asset classes that I track, either against the S&P 500, so that's the vertical scale. So all of those dots you see at the top are essentially equity asset classes, and you can see that they're generally highly correlated to the stock market, as you would expect. And then the correlation to the bond market, to long-term treasuries, is shown across the horizontal scale. And you can see, for instance, long-term treasuries by definition are 100% correlated to the long-term treasury index. So those are kind of the two binary parts of a portfolio. So the 60 is equities, more global. The 40 would normally be bonds, but I don't really like bonds here. I think, at a 4% yield, there's probably more upside risk to yields than downside. So I would tread lightly on the treasury or on the bond side. And that leaves you with what we call diversifiers, right? And those are asset classes with neither a strong correlation to equities nor to bonds. And those assets are there in the yellow oval. And so you have, of course, gold, Bitcoin, commodities, various alternatives like absolute return hedge funds or managed futures or market neutral. T-bills are in there. So you get a sense of like what is in that diversifier bucket. And so again, coming back to this notion of tails, we know what's in the middle. It's mostly equities and some bonds. But what's in the tails, right? There's nothing, as you can see from that bottom left corner, there's nothing that is not a stock or a bond that is negatively correlated to either stocks or bonds. The only thing there is the DXY, which is the dollar index. And that's certainly useful for Canadian investors to keep in mind. But other than that, the best we can hope for is just to have asset classes that are not correlated, not positively nor negatively. And clearly gold and Bitcoin are like, anyone who knows me, those have been my choice Gold is in a correction, which is fine. It kind of got a little bit ahead of itself at 4,400. We're now at 4,000. Might go a little bit lower, but bonds, gold does well when bonds do not. And so to me, that's a good hedge. So that's kind of how I think about a broadly based portfolio that can hopefully withstand some of the tills. And from then, it's a matter of rebalancing, right? Like if the stock market does completely blow off here, and that 60% turns into 80%, then you need to rebalance back to 60 because you don't want to be left holding 80% if that boom ever turns into a bubble, and then you get a drawdown on 80% instead of on 60. So rebalancing is certainly an important thing.
That's great asset allocation advice. Thank you, Jurrien. In the last couple of minutes, I'd be remiss if I didn't mention Bubble Watch. You've been on Bubble Watch all year. You talked about how there's a lot of retail enthusiasm in the markets right now, but yet you are seeing signs of insiders selling. How do you reconcile these opposing signals, and maybe provide us with a bit of an update on your Bubble Watch?
Yeah, so let's go to slide 7. Well, I'll be quick here. So the Bubble Watch has been, if the 2022 rate reset bear market was like 94, and then 23 and 4 have been more like 95 and 6, because in 95, the internet boom was born with the Netscape IPO. In late 2022, the AI boom was born with ChatGPT being launched. So where are we now? And we, as you see in the chart, it kind of looks like we're in early 1999, which makes you wonder, of course. But when you look at the valuation, so you look at Cisco's valuation back in the 90s, which was the poster child of the internet boom. At the top, the PE went to 215. That's a high PE for a big technology company. NVIDIA, on the other hand, is at a trailing PE of 59, a forward PE of 35, not even close. And also when you look at other parallels, for instance, if you look at slide 8, which shows the Nifty 50 from back in the 90s on the left, the PE ratio on the 50 biggest companies went to 40.5, while the PE on the other 450 companies fell to 19.8. So the top 50 were trading at twice the valuation of the rest of the market. If you go to the right, you see we have nothing like that yet. So I'm not worried that we are in a bubble right now that is about to burst. But, you want to be open-minded. And when you look at sentiment, and you mentioned sentiment, let's go to slide 11. You look at fund flows and surveys, like Wall Street surveys. Generally, people are enthusiastic, which of course they should be, because the market's up about 100% in the last 3 years. So why wouldn't you be enthusiastic? And so you see that, right? The investors' intelligence, bulls minus bear in the top, plus 45, so 45 percentage points more bulls than bears is what you would expect. But you look at the bottom, right? So that's the corporate insider selling buying indicator. So the ratio of insiders like CEOs and CFOs, officers of companies selling their own shares versus buying them. Generally speaking, the line is above, well above 1, because executives get paid in stock. They sell it to monetize their shares. So it's generally above 1. It's the times when it goes below 1 that are really interesting, and they tend to happen at market bottoms. So that means that insiders are buying more shares than they're selling, and they generally only do that for one reason, that is that their companies are undervalued. So it's a very good contrarian indicator at bottoms, and not so much as indicator of tops. But having said that, right now the ratio of selling to buying is 25, which is the highest ever for this series. And again, I don't want to read too much into that, but it suggests that maybe company insiders are like, you know what, these levels are getting up there. Maybe I should cash in some of my stock options. So just something to keep in mind. Appreciate that. Thanks, Jurrien. I think that's a good place to end it today. I want to thank you for your time and for helping us to navigate this narrow path between the two tails. Appreciate it, and have a great week, Jurrien. Great. Thank you very much.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.